Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We've been coming to you live from Philadelphia at the Nasdaq Villanova School of Business ETF Synapse, where we've been focusing on academia and research within the ETF industry. Helping me round off coverage for the day, we have Phil Mackintosh. He's our chief economist over at Nasdaq, and we are going to talk about demystifying fake news in the ETF space. Never thought I'd have fake news within a title of one of our hits here, but before we get into that, there's been some fantastic content out of this conference today, very differentiated. It's often you have the opportunity to talk about academia within the capital markets. What were some of the highlights from today?
Well, I think some of the highlights was getting some academic people who have studied different topics and getting them to describe what their work was, and then having the experts from the industry describe to them how the world actually works. And you start to see both sides of the story. I mean, a lot of the time, the findings from academic papers come out and you read them and you're like, how on earth did they come to that conclusion? Right. And what we're realizing today is that because they don't have great data, they don't have people sitting on desks, they don't have guys making and losing money because they're not on the bid at the right price, or their valuation models don't work, or they don't understand how you can actually do settlements more efficiently, that you would actually do things differently. So to have the experts on the panels with the academics and explain to them, it's like, that's not actually how I do things. You know, it's much cheaper for me to hold a position and wait for an investor to come the other way and just offset the flow to the other investor than to do a creation, pay for all of that, and then do a redemption with a different investor and pay for all of that and pay twice all of the settlement and back office fees.
Right.
So
was that like when they were discussing short selling ETFs and sort of demystifying the myths that's around that, where it's not necessarily a negative thing, but it's a positive risk management tool?
Yeah, I mean, and so short selling is one of those things that I think industry-wide people are kind of scared of.
Right.
And in reality, like the short selling for ETFs, you need to be able to short sell an ETF if you want to have an efficient market. Otherwise, they could get rich without a seller being able to come in and put them back down to fair value. So market makers perform that facility really efficiently, and a lot of the data that academics have done have actually proven that the ETFs track their benchmark very well, which is great for investors. But to do that, they need to be able to short. And if it's not a very liquid ETF, then it's not that easy to actually go and get the underlying ETF to match against your short trade. So you're going to have to hedge and you have to go borrow stock, and somehow you're going to have to actually keep your risk neutralized until you can manage to get rid of the actual security exposure that you've got to settle. Let's
talk about demystifying the fake news in the ETF space. What's that all about?
Yeah, well, I mean, we do have a fake news problem in America. We know that.
Really?
And it's all about ETFs. I mean, it's a little bit sad because ETFs have made such a massive impact to investors. They're a cheap product, they're a diversified product, and investors have voted with their feet. It's a nearly $4 trillion asset in 25 years. So it's clearly helped investors. We put up a piece of data that actually shows that investors have gained $1 trillion worth of extra wealth just by being in the ETFs, and that's before we count all of the transaction costs because they're relatively cheap to trade as well. But the media seems to focus on all of the fear-mongering about the fact that something can't get that big so quickly without it being bad. And it's passive, so it's not smart, and I just think that misses the point completely. The reality is the market is much bigger than the ETFs. There's a lot of hedge funds, there's a lot of active managers, there's still a lot of people picking stocks, so there's plenty of price discovery, and there's plenty of liquidity.
Right.
So the ETFs themselves, I think, are performing a really useful function for investors, and I don't think they're distorting the market nearly as much as people would like us to believe.
When we talk about investors, it's not retail investors. Institutional investors use ETFs actively as part of their strategy as well.
Yes, to some degree.
Right.
I think hedge funds use ETFs a lot because it's a really simple product to implement a multi-asset decision. It's like suddenly I like emerging market stocks and I want to short US Treasury bonds. You can do that with two separate ETFs and settle two separate trades. So for hedge fund, it's a really useful tool. For institutional stock picking asset managers, they're not used quite as much yet. And I guess that's because for them, the cost savings aren't as great. They're already putting portfolio trades to work, so they don't really need to put an ETF into their portfolio as well. But we've actually seen with the bond ETF space, a lot of insurance companies coming in and using the bond ETFs for cash flow management, because the bond market structure is really different than the equity market structure. We take for granted equity market structure with its lit quotes and access to trades instantaneously and deep market liquidity on the touch. Bond markets don't have quotes. You've got to request a quote on a ticker by ticker basis, and then somebody has to go and find who actually owns that particular QSIP or security to deliver. So it's much harder and much more expensive to buy bonds.
So it could take like days to settle.
It can take days to build a portfolio
trade, right?
in a bond portfolio, yeah. So the insurance companies have realized that not only are the equity market bond ETFs much cheaper to trade because their spreads are tighter, but they're lit and they can get in and out of positions much more quickly than spending days trying to put together all the pieces of a bond portfolio.
All right. Well, thank you very much for helping me round out coverage today in Philadelphia. And thank you for joining me throughout the day. I am Jill Malandrino, Global Markets Reporter.